All right, everyone, buckle up. The global stage just saw a dramatic escalation that's sending ripples directly into your wallet. In a sudden turn of events, Israel launched strikes against Iran, and Iran quickly retaliated with drone and missile attacks. This isn't just news from halfway across the world, it's already impacting your daily life here in America, right down to the price you pay at the pump. The immediate aftermath was a jolt to the global financial markets. Oil prices, particularly the international benchmark Brent crude, initially soared by over 10%, hitting their highest levels since January. While they've settled slightly, they remain significantly elevated, still more than 5% higher than recent closing prices. The U.S. West Texas Intermediate, or WTI, crude also saw a substantial jump, climbing over 7%. Now, why does this matter so much to you? Because the cost of crude oil isn't just some abstract number on a trading screen, it directly influences how much it costs to fill up your car. And it has a knock-on effect on the price of virtually everything else, including the food on your supermarket shelves. More expensive energy means higher costs for farming, transportation, and manufacturing. If these energy prices stay high for an extended period, you'll feel it in your household budget. A major concern among traders and analysts is the potential for conflict to disrupt oil supplies from the energy-rich Middle East. The critical flashpoint here is the Strait of Hormuz. This narrow waterway, bordered by Iran to the north, is one of the world's most vital shipping routes. Roughly one-fifth of the world's oil and a quarter of global LNG trade passes through it. Any significant disruption there could send shockwaves through the global energy supply. While Iranian media has reported that their upstream and midstream oil infrastructure, including the key Karg Island loading facility, which handles 90% of Iran's crude exports, was not damaged, fears persist. This lack of direct targeting on oil facilities means, for now, that Iranian supply itself may not be immediately curbed. However, the focus remains on how much the situation could worsen. Analysts suggest that if Iran's oil production and export facilities were targeted, Brent crude prices could jump to around $80 to $100 a barrel. Such a spike, however, isn't necessarily a sustained outcome. These same analysts point out that a sharp rise in prices would likely prompt other oil producers to increase their output, which would ultimately help limit the overall price increase and mitigate the inflationary impact. The International Energy Agency, the IEA, which was established to respond to global oil shocks, has stated that it has 1.2 billion barrels of emergency stocks available, ready to act if needed. Interestingly, OPEC has pushed back on suggestions that these surging prices warrant releasing emergency stockpiles, a stance consistent with their hunker down, lay low approach. For the United States, the situation is particularly delicate. The U.S. government has emphasized that it was not involved in Israel's initial strikes, with Secretary of State Marco Rubio stating that their top priority is protecting American forces in the region. President Donald Trump has also weighed in, indicating that Iran's actions affecting Middle Eastern oil supplies and consequently raising gasoline and diesel prices for Americans would be politically damaging to him. He even suggested that an outcome where Iran doesn't have nuclear weapons would be great for the market. Domestically, U.S. stock markets reacted swiftly. The Dow Jones Industrial Average, the S&P 500, and the tech-heavy Nasdaq Composite all opened lower, with significant drops after reports of Iran's retaliation. Investors sought refuge in traditional safe haven assets like gold, which saw gains, and the U.S. dollar slightly strengthened. The CBOE Volatility Index, often called Wall Street's fear gauge, surged 13%. The ripple effects extend beyond the financial markets. Shares in major U.S. airlines like United, Delta, and American, along with travel companies like Expedia and cruise lines such as Royal Caribbean, all fell. Conversely, defense contractors like Lockheed Martin and General Dynamics saw their stock prices jump. This reflects the immediate market sentiment regarding increased regional instability. Adding to the complexity, the U.S. Energy Information Administration, or EIA, had already projected that U.S. crude oil production would peak in 2025 and then decline in 2026, marking the first annual dip since 2021. This outlook, based on earlier lower oil prices, suggests that American oil companies might keep some higher cost reserves untapped. We've also seen a decline in active oil rigs, particularly in the Permian Basin, and a slowdown in Texas drilling permits. While the shale patch has started generating new pre-drilled wells, these domestic production trends are a backdrop to the current geopolitical volatility. Furthermore, President Trump's broader energy agenda could face challenges, as hinted by sources noting a big, beautiful bill could hurt his own energy agenda. His evolving stance on a nuclear deal with Iran, which he appeared unhappy with earlier this week, also adds a layer of uncertainty to regional stability. And his recent claim that China will supply rare earths to the U.S. is another dimension to the intertwined global economic and political landscape. Looking ahead, crude oil analysts are rapidly revising their forecast, acknowledging that geopolitics is once again trumping market fundamentals. While the tensions are undeniably high, many experts are guarded in their expectations of a full-blown, sustained war. They suggest that, given the stated U.S. goal of negotiation and de-escalation, a complete spiraling out of control might be unlikely, drawing parallels to previous episodes that were quickly diffused. The oil market, according to one analyst, had been complacent about the risk of geopolitical disruptions from the region. It's also worth noting that Iran's largest oil customer, China, has a vested interest in the unimpeded flow of oil from the Persian Gulf and stable prices. This economic leverage from China could act as a deterrent against any attempt by Iran to physically block the Strait of Hormuz, as such an action would undoubtedly bring severe economic pressure. The overall picture is one of heightened uncertainty. One chief economic advisor described the situation as potentially a bad shock for the global economy at a bad time, especially questioning the stability of the U.S.-led global economic order. Any rise in energy inflation, according to sources, would provide central banks, including the Federal Reserve, with another reason to proceed cautiously with cutting interest rates, potentially keeping them on the sidelines for now. However, historical context offers some perspective. Instability in the Middle East is not a new phenomenon, and previous bouts have often blown over relatively quickly. This current situation is not seen as significant a threat to oil supplies as, for example, when Russia invaded Ukraine. The speed and magnitude of any lasting impact will depend on how the conflict evolves in the coming days, and whether broader regional players become directly involved. So, while the headlines are alarming and the initial market reactions are significant, the coming days will be crucial in determining the longer-term economic implications for Americans. Keeping an eye on how this geopolitical situation develops will be key to understanding its full impact on everything from your gas tank to your grocery bill. Thank you for watching, and stay informed. I'll be back with more updates as this story unfolds.